Hey guys, it's Paul and Seth for this episode of Everything Money. Paul dives into the 8 amazing pillars that he looks at when buying a company's stock, from PE to all the financials. He gets into it right now. Stop buying those stocks based on what your friends tell you and start listening to your Uncle Paul right now on the Everything Money channel. Yeah. Paul, for the past 12 years, whenever I bought a stock, I simply looked at the price. Was it affordable? Did I like the company?
What did affordable mean to
I don't know. If it wasn't hundreds of dollars and I could buy it for...
Because you wanted to buy a lot of shares.
20, 40, 60, 80. Yeah, that sounds like a really great stock price, $20.
Yeah.
Regardless of what I was investing in, it really didn't matter. Again, I go back to, on like many podcasts I told you before, my friends just told me to invest in things that I really liked. Which, lucky for me, got me into Tesla, Netflix, Apple, all my favorites, and have all done really well. So that's our show. That's what you should do. I kid. Paul, tell us the top 8 pillars that you look at when looking at a stock. And I think this information is phenomenal. You definitely want to stay tuned to see how someone with a ton of money who does a lot of research on these companies really analyzes the health and profitability of investing in a company. Go ahead, Paul.
So this is not gimmicky, right? This is actually the stuff I look for, and this came over time. As I started looking at stocks, I found myself gravitating towards these things. And at the end of the day, I looked at them like, okay, there's basically 8 things that really matter to me when I look at a stock. Rarely will a stock have all 8.
Mm-hmm.
In fact, if it has all 8, I'm a little concerned. It's almost kind of like,
If it's too good to be true?
Yeah, it's almost kind of like that.
Like Bitcoin.
Something like that.
Keep going.
It has 0 of these. But over time, as you get your own personal foundation of what matters to you, there are certain things that go to the top. These are the 8 that go to my top of my list, okay?
We'd love to have you at the top of our list. Please smash that like button in the bottom right corner there.
Correct.
Yeah. Paul loves his likes. He's like a teeny bopper.
I check it all the time. I really do.
He checks it and texts me all the time. Please like this video for Paul's sake.
Seth and Don have stopped even answering my texts. I'm like, man, we have 287 likes in 3 hours on this video. This is great.
He needs all the help he can get, folks. He's struggling. Go ahead, Paul. Tell me about these top 8 pillars. Go for it.
Okay, so the very first one, and we're going to use Microsoft's example, and I picked Microsoft specifically because it has a lot of these.
Microsoft. Now, we almost came to blows yesterday. You love Microsoft so well, and I'm an Apple, and I love Apple so much.
You want me to do Apple?
No, do Microsoft.
Actually, I'll do Apple.
No, please do. Please. Be the outlier, the one person in the Microsoft store who's buying their stuff.
It sounds good. So Microsoft. This is my Y charts. You don't need Y charts. You can go to Google Finance, Yahoo Finance, get all this information. It's free. You can Google anywhere. You can go to the company website. They give it all to you.
Mm-hmm.
So I go to the financials first. And what I like to do is I don't look at just 1 year. I like to look and see how the company's been doing for the last 5 years or so.
Pillar number 1 is revenue growth over the last
5 years. Pillar number 1 is revenue growth. So right here, we look and we say over the last 5 years, what has Microsoft's revenue done? This past year is 143, 126, 110, 96.5, 91.
I like when you go in the other direction because it builds better.
Okay, 91.5, 91 billion, 96 billion, 110, 125, 143.
Huge growth.
A lot of growth.
Yeah.
But for a dead company, like you were telling me to say, how the products suck.
Yes.
It's a lot of revenue growth.
Anyhow,
so this automatically hits pillar number 1. We have good, consistent revenue growth. Can we figure out what that revenue growth is? Of course we could. Again, I'll get into numbers that you don't necessarily need to know, but this is solid revenue growth. That is the first pillar.
Pillar number 2.
Pillar number 2, profit growth. So I go down to my net income number, right? And I go back 20 billion, 25 billion, 17, 39, 44.
Okay.
But we still have, starting at 20, and this is an aberration. I'll look at that going, okay, something probably happened that year. They probably wrote something off. But all in all, what do we see here, Seth?
Massive growth.
Okay.
Doubling in 5 years.
Check number 2. We've hit the 5-year profit growth as well.
Yep.
Good, consistent profit growth, right?
Pillar number 3.
Pillar number 3 is free cash flow growth. Now, what is free cash flow, Seth?
I can't remember. Tell me.
Okay, free cash flow is what the company will use. It takes their operating business, what their regular business is, all the cash flow from there, pays for all their capital expenditures. Capital expenditures are things like, in the real estate world, things like putting a roof on, all the things they do to make their company, to invest back in their company, machinery, buildings, things like that. And what's left over? They use that money to pay dividends, to buy stock back, to pay down debt, to grow, things like that they can use there. So free cash flow is a major component to companies to show how they're able to generate money and then grow from there.
Okay.
So how do you calculate free cash flow? You go to the cash flow statement. You look at their cash from operations, and you subtract out the capital expenditures. So last 5 years, 33 minus 8, 25. 39 minus 8, 31. 43 minus 11, 32. 52 minus 13, 39.
Wow.
60 minus 15, 45. What do you see here?
Growth, consistent growth.
Very consistent growth. You remember that 1 year they lost money? They still had free cash flow. So it tells me another indication is that one loss was probably a write-off.
Okay.
But they use this stuff to go make acquisitions, things like that. This is important. So every year the company's cash flow has been increasing. The free cash flow has been increasing. So check mark number 3. So what's pillar number 4, Seth?
PE ratio, Paul. Now, I'm an expert at PE ratio. This is, I've learned. Now, I would say, Paul, 2 years ago, obviously, I had no damn clue what any of this is. But this is price to earnings ratio.
And it can be figured out 2 ways.
Tell me.
You can take the stock price, 205, and you can divide it out by the net income per share. Divided by 582, which is roughly 35.
Okay.
Or you can go and you can take the market cap of the company.
What is it now?
1.55 trillion.
Oh my gosh.
And divide it by their net income the previous year of 44 billion. It'll come up to pretty much the same number, 35.
Now this scares me.
What
now.
do I want to get?
So I know typically you want something around 15, but you're coming up with what number?
Anything below 20 to me is going to get an automatic. Okay, now I want you to know I'm looking for below 20. Seeing 35 isn't necessarily a deal breaker if it has everything else. I have to understand why it's so expensive. Is it expensive because it's fast growing? If that's the case and can justify it, great. But is it expensive and high PE because everybody in the world likes it or everybody in the world wants it, gets the hot stocks up a lot? That's when I have a problem.
So the hype will increase the price, which might not reflect the earnings and will elevate this number.
Yes, and think about it that way. If it's hyped, everybody wants a stock. When everybody wants a stock, what happens to the price of the stock?
Goes up.
Goes up.
Supply and demand.
Correct. So here it's 35. So we have a red X on the PE. So we've gone through 4 different pillars so far. Half the pillars, we have 3 green check marks and 1 red X.
What's an extreme number for PE? Something like Tesla.
Oh, Tesla doesn't even have a PE, I don't think, because they haven't had profit in 1 year yet.
Okay, well, what about
Let's go
what's
to
another
Amazon.
An overhyped company?
Let's go to Amazon. Amazon PE. Look at this.
120.
120.
That's a lot.
Yeah. Don in the back just said Jesus. Do you have a microphone there, Don?
He does.
I do.
Jesus is right. It's a lot. And by the way, this is down a lot. It used to be like 400 or 500.
All right, go back to Microsoft.
So let's get back here to our good friend Microsoft, the company that Seth loves to hate because he has no idea what he's doing.
Yep.
Okay, so back to Microsoft. We've gone through the first 4 pillars. 5th one, total current assets greater than total current liabilities. So what does that mean, Seth?
So your assets is like
Total current assets.
total current assets. This is like the stuff that's worth something to you, like their stores, their inventory.
Not the stores, but cash on hand,
Okay,
inventory. It's things that can be converted into cash very quickly,
got it.
right? It's on the balance sheet. You just go to total current assets. What are their total current assets, Seth?
Well, 181 billion.
182, let's call it.
Okay.
So I want to sit there and say, do they have enough money to pay their current liabilities? Current liabilities, if current assets are the money that can be exchanged quickly, current liabilities are the bills and money owed very soon. So basically, to use an analogy of our individuals, if you have $10,000 in your bank account and you have $8,000 in bills that are due in the next 30 days, you're probably okay.
Yes.
Next year, yes, you're probably okay. If you have $10,000 in your bank account and you owe $15,000, you're gonna have problems.
A lot of people are like that.
A lot of people are like that. So current liabilities for Microsoft. Can you read it out loud for me here, Uncle Seth?
Well, we got to go backwards. Oh, it's just 72 billion.
72 billion.
What was the assets?
180 some billion.
Oh my gosh! Wow.
So they have over $100 billion in net current assets.
That's a lot of money.
That is a lot of money. This is phenomenal. Most companies don't have this kind of ratio. This is huge. Another check mark for us. So we've gone through 5, and we have 4 green check marks. So far, so good. Okay, now.
Pillar number 6.
Pillar number 6 is a price to free cash flow less than 15. So.
Price of the stock?
The price. So basically here, I'm going to look at the total value of the company and divide it by last year's free cash flow. So if you remember, the value of the company is 1.55 trillion, right?
Yes, it's crazy.
Right? 1.55 trillion. If I want it to be less than 15, what we're going to try to do here is we want to sit there and say 1.55 trillion divided by 15. We want to see free cash flow of $100 billion or so. Do you remember what the free cash flow was in the last year?
180?
No, remember the free cash flow.
Oh, that was total assets, sorry.
Yes, total current assets was 180. The free cash flow was around 60, I believe. Nope, sorry, 45.
Uh-oh.
So we got a problem there. It's selling for 35 times free cash flow. We want it to be under 15. Get another red X here. It makes sense that the PE and the price of free cash flow would be very similar. Over long periods of time, they're very similar. So it is kind of hard. So some people might ask me, well, why is the PE less than 20 versus free cash flow 15 if they're very similar? I won't get into the accounting of it, but PE involves depreciation, other things that free cash flow adds back in. So right here, we have another X. We've gone through 6. We have 2 X's, 2 red X's, and 4 green check marks. Again, not the end of the world if we can make a play, if we can understand why that is.
Pillar number 7.
Pillar number 7, profit margin greater than 10%. Now this, I want to be the bottom line profit margin. This is after taxes, all after everything. I want it to be greater than 10%.
This is hard to achieve, Paul, I think.
Is it? Depends on the company.
What do they got?
29.45%. Software companies tend to have very high profit margin.
Because?
What does it cost to make software? Once you've made it, it's just replicating it over and over and over again.
Does the health here of this large pillar number 6 counteract
7 profit margin?
Profit margin. Does it counteract some of our red X, the pillars that haven't been met?
It can. For a company like Microsoft, sometimes when I see a high profit margin, I get worried, going, oh my God, there's going to be so much competition. But Microsoft has such a control on the market. And to go replace Windows, to go replace Microsoft Office, what would that take?
No one's done it, right, in 20 years?
Google's doing Google Drive, as you said yesterday, which is great, but
not as perfect.
Not as perfect, not as awesome, but it's still doing well, and people still use Microsoft Outlook and all these things.
Yeah.
Like, I hate Gmail. Do you like Gmail?
I love it.
Oh, it's the worst.
Okay.
Outlook to me is the bomb hizzle.
Speaking of the bomb hizzle, Paul, the bomb. I
Drop a bomb on that like button.
Hit the bomb. Smash, destroy, drop a bomb on that like button, pretty please. We thank you for watching. Keep going, Paul.
So, their profit margin, well over 10%. This is after taxes, by the way. So, I think we're good there. So, through 7 pillars, we have 5 green check marks, 2 red marks.
The last pillar.
Last pillar, decreasing share count. Now, people would wonder, why the hell do you care how many shares they have outstanding?
We've talked about this on shows, if you want to go back and listen. I'm an expert on this now, Paul, as well, is that we want the share count to go down.
Why is that? Because
we want the company buying shares back from the public, which is a very healthy...
Not necessarily.
Okay, sorry, I'm stupid.
No, you are right. I would rather have them staying the same or decreasing than increasing. So what a lot of companies will do sometimes is to make acquisitions, they'll issue more shares. And to grow, they'll issue more shares. Well, what happens is, if a company has 10 shares outstanding and you own one of them, how much of the company do you own?
$1. 10 shares divided by 1?
There are 10 shares outstanding.
10%.
Correct. You own 10% of the company.
Got it.
Now, let's say tomorrow they want to buy another company for 1 share. They want to buy another company for 10 shares. They issue 10 more shares. You still own 1 share, but how many shares are outstanding now?
20.
So what percent of the company do you own?
50%. So
5%.
5%. Half of 1.
So you went from 10% down to 5%.
Oh my gosh.
So they diluted you.
Yes.
To me, that isn't... Now, granted, they could be doing it for good reasons. But a company like Microsoft with that much cash, they shouldn't be issuing more shares.
Mm-hmm.
So I'm going to go back over 10 years. 10-year share count. And I'm going to go look. And here on Y charts, it's share data is average basic shares outstanding. In 2010, how many did they have, Seth?
I can't see, but go ahead.
8.5 billion. And today they have
7.6 billion.
7.6 billion. So they're not increasing. They're not staying the same. They're decreasing.
Decreasing.
They've been decreasing the number of shares outstanding. That's something that a lot of companies do with the excess cash because it's probably hard for Microsoft to go spend $60 billion, $45 billion a year when they get it. So what they do is they reward the current existing shareholders by saying, hey, we're going to decrease the number of shares. Now, instead of you owning less of the company, you now own more of the company for holding the same amount of shares. It's kind of like a way of rewarding the investors. I won't get into the more specifics of it, but you don't want them buying shares that are expensive. Like if their company's overpriced, like right now, I don't want them taking their cash to go buy those shares. But altogether, I want to see a decreasing share count or at least the same. So again, Microsoft has that. So on 8 pillars, we had red X's on 2 of them and green check marks on 6. Unfortunately, the 2 red X's are on very big important ones. I don't have these listed by importance. Those are the ones that matter to me the most. Microsoft, to me, is too big of a company to pay that big of a premium for. I'm not a buyer of Microsoft at $205 a share. Because to me, 35 times earnings is too much for how big they are. If they were 1% their size that they are right now, and they had a lot of growth potential still, I would sit there and might look past it saying, oh, you know what, they could grow 20, 30% a year. They're not growing 20% a year. What are they growing right now? Last year to this year, they went up 11, 12%, which is still a lot.
Yeah.
But how many acquisitions they make, it's not enough to justify paying double what the market would normally justify, especially in this market of overhyped. It's been one of the biggest, hottest stocks for a long time.
What are you buying this? What would you like to buy this stock?
Sub 100.
It's at what?
It's at 203. I want to buy it sub 100.
That's a hell of a drop.
Let's see.
So until it gets there, you're not buying Microsoft.
I'm not buying Microsoft till it gets there. And by the way, it could in the next 5 years. You could justify it's $200 a price, and I buy it then at $200. I'm just telling you for right now, right here, right now, I'm not buying it for less than $100. And by the way, when was the last time it was in December of 2019? It was at $100. Wasn't that long ago?
Yeah.
18 months ago, Seth. You're telling me in the last 18 months, Microsoft as a company has doubled in its value. It should have doubled in its value.
It hasn't.
It's not that long ago, guys. So when you hear 200 and you go, that's too high. Well, guess what? 100 was right here, kids. 2019. The start of 2019. I'm sorry, the start of 2019. Not December 2019. It was December 2018. January 2019, it was $100.
As a normal person, Paul, that's not you doing this all day, this seems like a pretty excessive look in terms of buying a stock.
This is very 500 for you. I haven't even done the hard stuff yet. Here's what you do. Watch our videos, get ideas, think about things, do your own research. If you're okay with, look, I'm just trying to provide another way of looking at things.
Yeah.
When you're buying a stock, you're buying a piece of a company. If I were to tell you tomorrow, go buy Acme Corporation in Cleveland that's not publicly traded, what would you do? You'd ask for financial statements.
Yeah.
That's all I'm doing here.
Well, I mean, most would. I guess that's the point. As a normal person, Paul, you've taught me to take a look at all this stuff when in the past I would just buy things like Tesla
without knowing what was behind it
and Bitcoin. And then I started realizing, like, every second that I have to leave my family to go make money, it's like, it's hard to make money. Then you come home, but it's not hard to go in Fidelity and just buy these things.
It's not.
Because my friend told me I should.
Yep.
But their friend they should listen to is Uncle Paul.
Listen, I'm going to be wrong on a lot of things. I was reading books recently. Peter Lynch is one of the best investors ever. He always said that he was hoping that a third of his investment ideas worked out the way he thought they were going to in 3 to 6 months. A third. But the whole point is the 2/3 he's wrong on, he doesn't want to be wrong on by a lot. They might go up 10% instead of 40 or 50%. But he wants to be right on a third of the ones that he picked. All right, I'm not going to be right on every single one of them. I bought Microsoft at $23 a share in 2011 when everybody told me I was stupid. I sold it at $55 a share thinking it was overpriced. Now it's at $205. Do the math.
You big dummy.
Big dummy.
But you're consistently
dumb.
Patient.
Patient. I'm very patient. I don't think I'm losing out on these kind of things. I'm like, there'll be a time when Microsoft sells for a lot less money, and I'll buy it then.
And that's what you should do too.
8 pillars. Every time we go through a stock now, we're going to go through the 8 pillars. We're going to have check marks and X's, and it doesn't mean that if it has only 2 check marks, it's not a buy. It's just about looking at the whole picture. Investing is an art, not a science. If it was just as simple as saying, oh, it's got 6, as long as it has 4 check marks, you're good, you should buy it. That's not the way it is. Each check mark is worth a different amount in terms of how important it is in the company.
Comment below, argue with Paul if you want to. He'll respond. Thanks for liking the video. Thanks for subscribing. And as always, thanks for supporting the Everything Money channel with Paul and Seth. Thanks.